Welcome to FT Markets. Over the past 3 sessions, the oil price has seen marked volatility, rising by more than 25%. Here to discuss the drivers and where we go from here is the FT's Deputy Commodities Editor, David Sheppard. David, could you give me an idea of what caused this spike over the past 3 sessions and yesterday when prices were sort of rising 8–9% when it was a public holiday in the UK?
Well, what we've seen is this 3-day rally, which can really split into 2 parts. The first at the end of last week on the Thursday and Friday, which many traders attributed to a vast short covering rally by hedge funds and other large investors who'd been betting against the oil price. Going into the long weekend, no one really wanted to be short the market in case there was some news which triggered a recovery, especially after we'd fallen so far, so fast at this beginning of last week. As a result, we saw a number of funds scrambling to close out positions, which caused the initial spike in prices of around 18 to 20%. However, coming on Monday, there was some real news which seemed to trigger another leg up on the oil price spike. What we saw was, first of all, OPEC came out with a statement which some people interpreted as a possible hint of a change in direction from the cartel. While many people think that the language they used only reinforced their existing notions that they were going to continue to produce as much as they wanted to, but would hope to eventually see demand create a price recovery, others saw it as a slight change in the language, as they described a fair price, language they last used when talking about a price of around $75 a barrel.
Okay.
Going on from there, though, there was also data out of the United States which showed the first real evidence of a slowdown in US production. While we've seen US oil drilling rigs falling for months, we've yet to see any real evidence until this week of production actually falling as opposed to just slowing.
Okay, so if we look at this chart here, bringing it up, I mean, we can see the oil price fell to sort of a 6.5-year low at the end of August. So we had a sort of a vast short covering rally by short-term financial market players that put the price up. But now we've actually had some fundamentals. So does that mean we've seen the lows for the oil price? If the fundamentals, US supply is actually looking like it might have plateaued, I mean, where do we go from here?
That's very difficult to say at this point. Certainly when you get a rally of that kind of magnitude, it will have some people discussing that is the end. That's it. The lows are in. Going to bounce back from here, and we might even continue to go higher again. However, some people are saying that this was still a technical driven rally. While the fundamentals may have improved slightly, the real supply and demand in the market is still heavily weighted to the supply side. Citigroup, for example, came out yesterday and said that this was a short-term move and that prices could once again revisit the lows that we saw last week, down below $40 a barrel, and we could even go lower again towards 30 or even 20.
And just go back to the point you made on OPEC, this change of language. I mean, it sort of seems to me OPEC saying, we need to talk about production and levels and things like that isn't really a marked change of language at all. It doesn't sort of indicate that there's going to be any real change from the cartel, surely.
Well, the key thing here is probably Saudi Arabia as much as anything else. This was a communique from the OPEC monthly bulletin. It's written by the guys who work in their Vienna headquarters. It doesn't necessarily have input from all the major countries or sign-off from Saudi Arabia. Now, some analysts think that OPEC won't say anything without the approval of Saudi. However, from what we know is many of the senior Saudi oil industry people are still on holiday at the moment at the end of August. So the language really was an incremental shift, which may not have been signed off by the top guys who actually make the decisions in terms of what the production will actually do. Certainly Saudi Arabia, the world's largest exporter and the most powerful member of the cartel, has not come out with its own statement yet saying that there's been any move in their policy of keeping production high and trying to squeeze out lower cost producers.
Okay, then to sum up, this rally then, it looks like the market was looking for an excuse to send prices back up after they were flattened at the end of August, and it just alighted on this OPEC sort of statistical magazine and also the first perhaps one of the first indications that US production might be plateauing. So there was almost an excuse to push prices back up, but it doesn't mean necessarily that we've seen the bottom yet.
That seems to be correct. I mean, the one thing with the US production, though, is that could be a trigger. The market has been waiting for a real indication that the US is slowing down. They've always been seen as the primary target of OPEC. So to get real evidence that the US is now not just slowing, but actually falling in terms of their output, that could be something which triggers more gains.
But we should treat that data with caution, because this report from the US Energy Administration, I think I'm right in saying they used a new methodology to calculate the production numbers from what they've done in the past. So we've only got one data set really here.
That's correct, and it only goes to June. So of course we've had 3 more months since then of increased volatility. And increased supply that we've seen coming through in the US weekly stock figures, which show very high stock levels.
David, thank you very much.